Evening. I read this definition last week, and I'm gonna come back to it again. Derivatives can be used by an investor to hedge risk in an underlying share portfolio or as a trading tool to realize a profit. It can be an excellent way to round out an existing portfolio and offers a wide range of options, including international opportunities. I haven't got a clue what I've just read. That's why I've invited Allan Thomson, head of derivatives and equity trading on the JSE, to join us. How's it, Al?
You didn't, Jeremy.
You will?
Thanks for having me. Yes,
Yeah.
thank you.
Okay, is that a clear description?
It's a description.
Right. What is a derivative then? Tell me.
All right. You say we've only got half an hour. I'm not quite sure that that's going to be adequate. But derivatives, in essence, can be extremely complicated. But in their most basic form, they are actually very, very simple instruments that anyone can understand.
Okay.
And the problem with derivatives is that they're cloaked in jargon. So there's lots and lots of jargon around derivatives that tends to throw the person wanting to learn a little bit more about them off right from the word go. But let's just quickly start with a very, very basic derivative. And where did they start? The ancient Phoenicians were believed to be the first people who actually started with derivatives. The Chinese had them. And if they could use them back then surely they're not too complicated for us to use now.
Okay. Right.
And the basis, most of them had their
You
basis.
are speaking Phoenician at this stage to me.
Okay. Well, we haven't got there. But the basis of these things is actually quite simple. And most of them started in the agricultural market. So I'm going to start by using agricultural examples to start, because most people understand that.
Right, now we're on the same page. I come from a pineapple farming background.
Right, let's assume
Let's
that
talk
you're farming
pineapples.
in pineapples.
Yes.
So you, Jeremy, are farming pineapples.
I'm down in the Eastern Cape.
In the Eastern
I'm
Cape.
farming pineapples just outside Bathurst.
And you haven't planted your pineapples yet. But you know you're going to use diesel to plant them for the tractor. You know, you got to, I don't know if you plant seedlings or seeds.
No, you take the top of the pineapple, and you put that in the soil and it grows a pineapple on top of it.
Cost to that, and there's labor, and there's diesel.
Yeah.
So you know what it's going to cost you to plant your pineapples, and hopefully at the end of the day you're going to have a crop.
Right.
But you've no idea what you're going to get for the crop. Let's say to plant 10 hectares of pineapples, you know it's going to cost you R1,000,000. But you don't know whether you're going to get R1,000,000 for your pineapples at the end of the day.
Okay.
However, you can go now and sell your pineapples even before you plant them. You can go and find somebody who's willing to buy those pineapples for you because he wants to make pineapple bread, or I'm not quite sure what you do, pineapple rings. Somebody wants to sell pineapple rings, wants a steady supply of pineapples, and he wants to know he can sell them in the shop for a price, but he wants to know what that price is. So he will buy the pineapples for you now at a price that we agree right now, but the sale will only happen sometime in the future.
Okay, wait, no, I don't understand this.
Okay, so you
already. You mean there's some oak out there who is stupid enough to buy my pineapples from me before I've even planted them?
No, he will agree a price at which you will then, if you have pineapples, let's hope you're a good farmer. If you're a bad farmer, you're not going to have pineapples. But we will agree a price at which you must deliver your pineapples to him. So when your pineapples are there, you will deliver to them at 10 Rand a kilo, which you have agreed now, today.
Okay, so I sit down and I work out, I've got 10 hectares and it's going to cost me R1,000,000 to plant my pineapples and to get them to the stage where they can be picked.
Yeah.
And I sit down with you at the Pick and Whistle in Bathurst and you say, Jeremy, I will buy your pineapples. How much do you want from them at the end of the season? And I say to you, I want 1.2 million Rand, because then I know I've made 200,000 Rand.
Yes.
And you say yes.
Yes.
I will buy your pineapples from you for 1.2 million Rand, those 10 hectares.
Quite correct.
If I only give you 5 hectares because for whatever reason the crop doesn't work, then you only pay me 600,000 Rand for those 5.
Yes, we get into some complexities in the derivative world. If you've already sold 10 hectares and you've only got 8, you're going to have to go and buy 2 to go and give to him.
So I have to actually deliver.
You have an obligation to deliver.
Okay.
Quite right. You have an obligation to deliver that quantity at that price on that date.
Okay. Now, is that a derivative?
That's a derivative. So that is the most basic form of a derivative. That we have now derived the price for pineapples from the planting that you are going to do. It's a forward contract. It's what, now let's throw some jargon, some common jargon into it. It is an OTC, over the counter. That counter that we're talking about was the pub in Bathurst.
Yes.
So over the counter, you and your mate decided on a price for pineapples, and it is a forward contract because it is sometime in the future, forward. You have agreed a price, but you've agreed that price today.
So
and there we have the most basic derivative contract.
So it's a forward over-the-counter contract. Contract for delivery. So you will deliver your pineapples at a specific date, at a specific price, which was agreed beforehand. Okay, right. Now,
got that one.
I've got that, absolutely. I understand that 100%. Yeah. Thank you very much. It's been wonderful having you this evening. And that was our discussion on derivatives. Or is there more that you want to add to that?
A little bit more than that. So let's take the next step.
Okay. Now, you see, I just thought I thought to myself, this is the first show that I've done in this series that I've actually understood everything. But now you're going to make it even more complicated, aren't you?
Yes, a little bit. Okay. But now it becomes fun. Okay. Yeah, the fun part starts.
Right. So we can do this. We can do a forward over-the-counter contract for anything. It can be wheat. It could be
Anglo-American, the all-share top 40, the rand, the dollar.
No, explain that to me now. Because I don't understand. How do you do a forward over-the-counter contract with the rand?
Well, you just sit at that same mate of yours, and for whatever reason, you might want to hedge your rand, or you might have a rand exposure, or you might even just have a feeling that the rand is going to weaken, and you'll say to your mates, I will buy dollars from you at R7.50 in 6 months' time. So instead of pineapples now, we're just delivering rands.
Dollars.
Or dollars, sorry, what did I say? Dollars.
Yeah. So in other words, so I reckon that there is a chance that the local elections are coming up. There may be a bit of friction in the country. The rand may strengthen or weaken.
Let's say weaken. Let's say you are petrified that the rand is going to weaken beyond 8, between 8 and 9 rand.
So I say to you, I will buy them at R7.80 to make
R7.50. I think is about the forward price.
Fine.
Somewhere there, R7.50 in 6 months' time.
And I say to you, square. We got a deal.
We've got a deal. Yeah.
6 months' time, I have got to, no matter what happens.
You have an obligation.
I've got to hand over those dollars to you at that price.
Well, you've got to buy. In this case, in our example, you were buying the dollars. So you will hand over R7.50 and he will give you $1.
Okay.
And we've agreed, let's say $1,000. So you will hand over 7,500 rand and he will hand you over $1,000, irrespective of what happens, where the market is.
Okay, now, that to me makes these things very risky. Because I don't know. I've got no way of
let me put it this way. Let's assume you are buying a new piece of equipment that picks pineapples automatically, and you're importing it from Idaho in the States. And this thing can only be delivered in 6 months' time. And you've put aside all of your savings and you can afford to spend R1 million on this thing. And that translates into so many dollars. But if the rand dollar price weakens considerably, by the time that this thing arrives in South Africa in 6 months' time and you have to pay cash for it then, and the dollar's weakened, you can't afford it anymore, then you've got a problem. So why not secure that price now when you know you can afford it, and you take out any risk of the rand weakening and you not being able to afford your piece of equipment? So what you are doing is you're in fact eliminating risk. Completely eliminating risk from your business transaction, which is exactly, let's come to the stuff that wasn't in your definition, what a derivative is there for. A derivative is a very efficient mechanism to transfer risk from someone who has risk and doesn't want it to somebody else who doesn't have the risk and is prepared to accept it.
Why would you be prepared to accept somebody else's risk?
Well, let's just say a speculator. If you're a speculator and you're prepared to accept risk for financial gain, then you may very well want to buy it. But you might be on the other side of the transaction. I might be wanting to hedge a very weak rand. An exporter might be wanting to hedge a very strong rand. So we've got completely opposite views. So all we do is we swap out our two different risks. I take on your risk, you take on my risk. And we've neutralized both of our risks.
I can understand who let's call it the client is in a derivative trade. I'm the pineapple farmer. Who is the oak who sits down at the Pig and Whistle with me and says, I'll buy your risk? Who are those people? Are those people who are cash flush, who want to take on risk because they see opportunities
could be a combination of any. In our pineapple, it's the chap who is going to buy the pineapples for you, slice them up, put them in a can and sell them to Pick and Pay and Spar. So he wants to know the price that he can sell pineapples at. And he knows that if the pineapple price goes up substantially and he can fix his price now and his competitor hasn't, then he's got an economic advantage. So he would want to eliminate his risk. So he's a manufacturer in the process. It would be a miller, for example, in wheat or maize. It could also be a speculator. And the speculators are often maligned in the markets, but they are absolutely vital in the market. We can't have a market where it's just speculators, then we run in a casino. But a speculator is important to create that liquidity and to do exactly that, take that risk off you. And because what might happen, for example, is that chap, that chap that we talked about in the bar, he might not pitch up that night, he might not be there, but he might come a few nights later on. You need someone to sort of work the middleman, to take it from you and on-sell it to him a few days later on. And that's what speculators do in the market. They just grease the wheels of the market and make it work efficiently.
Okay. I think I'm still with you. So I hope you folks are still with us here as well. If I'm with Allan, then I reckon you are as well. Let's take it another step forward then.
Yeah.
If you have these derivatives around, how do you buy into them?
Right. I mean, that's a good question. You're going to have to bear with me for a little bit. Not everyone has access to your pub in Bathurst.
Yeah.
And that agreement that you had is a very unique agreement with a chap on the other side of the pub with you. So now we want to expand it to everybody else. Let's just take one step back, or in this case even forward. Let's assume that there were many, many pineapple farmers. You were just one of many in Bathurst, and there were many buyers of pineapples. So instead of just doing a transaction with you, what he could do is I could buy an agreement with you, and then in a few days later I might decide I don't want this anymore, I'd like to sell it, and sell it on to somebody else. Now, those contracts have to be standardized. In order to do that, I have to know that the pineapples that you're going to deliver me are of a certain quality and a certain standard, so that the next guy who gets it knows what he's getting. And that's when exchange comes into being. So an exchange will standardize all of these contracts and bring all of the buyers for the pineapples in one place together, and all of the farmers, all of the guys together, and anybody else who wants to buy and sell pineapples.
Okay, so now we're getting into an exchange area.
Yes.
Right. We're coming back to that in just a moment. Excuse me, because we're talking about sitting down in a pub in Bathurst so much that I'm going to have to try and find out if we've got a beer somewhere in the studio. We'll see you in just a moment.